Welcome to Talk Tickers.
Hey, great to be here for this.
So, if a doctor misreads an x-ray, they miss a broken bone, right?
Right.
But if a financial analyst misreads a company's pension ledger, well, they might recommend buying into a business that is, secretly bleeding tens of billions of dollars.
Yeah, tens of billions. It's wild.
You look at the income statement and you see robust earnings per share, and you think you found this great value play.
But beneath the surface, it's a totally different story.
Exactly, because complex accounting rules are basically masking this massive compounding economic sinkhole.
I mean, it is arguably one of the most dangerous blind spots in equity valuation today.
Oh, absolutely.
The rules governing how these liabilities are measured and reported, well, they were explicitly designed to smooth out volatility, which, sounds great in theory.
Right. Everybody loves smooth earnings.
Exactly. But in practice, that smoothing can completely detach a company's reported financial health from its actual real-world economic reality.
So, for you listening, whether you are, say, prepping for a CFA exam, or you're gearing up for an intense equity analysis meeting, or, you just want to understand why some of the biggest industrial giants seem to occasionally bend the laws of financial physics, welcome to this deep dive.
We've got a lot to cover today.
We really do. Today, our mission is to completely untangle a foundational CFA-aligned financial analysis concept, which is defined benefit pension accounting.
And it is a beast of a topic.
It really is. We are going to explore the severe divide between funding and accounting, the historical illusions created by expected returns, and the demographic time bombs hidden right there in the footnotes.
Plus, we'll get into the cutting-edge math required to value modern hybrid plans, which is just fascinating.
Yeah, and we are dealing with staggering numbers here, right?
Oh, absolutely staggering. I mean, for a legacy automaker or an airline or a major telecommunications firm, the pension obligation can easily rival or sometimes even dwarf the market capitalization of the company itself.
Which is just insane to think about. The pension is bigger than the company.
It happens. And misjudging that liability by even a few percentage points changes your entire thesis on the stock.
So let's just start by defining the core promise here. A defined benefit pension plan is essentially a massive deferred compensation contract.
That's a great way to put it.
The employer asks for your labor today, and in exchange, they promise a specific formula-driven income stream for the rest of your life, starting at retirement.
Right. But measuring the current cost of that future promise, it requires us to split the world into two completely separate realms.
Funding rules and the accounting rule.
Exactly. And they operate under entirely different mandates. It's like they don't even talk to each other.
So let's talk about that divide. Funding first.
Right. So pension funding is governed by tax codes and labor laws, like ERISA here in the U.S. The absolute mandate there is benefit security.
Meaning making sure the money is actually there when the worker retires.
Precisely. The government requires the company to deposit actual hard cash into a legally separate trust. They want to ensure that when a worker retires in, say, 30 years, that money is completely untouchable by corporate creditors.
Even if the company goes bankrupt.
Right. So funding is tangible. It is cash physically leaving the corporate checking account.
Because, the government doesn't care about a company's earnings per share.
Not at all.
They just want to make sure taxpayers aren't left holding the bag if the whole thing collapses.
Exactly. The government is looking at downside risk. But then, you cross over into the accounting realm.
Right, the wild west of GAAP.
Yeah, governed by the FASB under U.S. GAAP, or the IASB if you're looking internationally. And their mandate is absolutely not benefit security.
What is their mandate, though?
Their mandate is the matching principle of accrual accounting.
Ah, right, the matching principle.
Yeah. They want to equitably allocate the cost of the pension over the employee's entire working life. So they were trying to match the expense of the labor to the revenue that labor generates in the current period.
Okay, so if an engineer is designing a microchip in 2026, the economic cost of the pension benefit they earn for that specific year of work needs to hit the 2026 income statement.
Exactly right.
Even if, the cash to actually pay that benefit won't be distributed until, 2055?
Yeah, exactly. The cash flow and the accounting expense are totally decoupled in time. And to do that, actuaries have to measure the total size of the promise today.
Which is where it gets incredibly complicated.
Oh, yeah. They use three distinct liability metrics to do this.
Yeah.
You've got the present value of future benefits, the projected benefit obligation, and the accumulated benefit obligation.
Okay, that's a lot of acronyms. Let's tackle the PVFB first, the present value of future benefits.
So this one is the absolute maximum theoretical liability.
Right, like the biggest possible number.
Exactly. It projects an employee's career all the way to retirement. It assumes they stay with the company the whole time. It assumes all their future promotions and salary increases, and it calculates that final massive retirement annuity.
And then it just discounts that entire amount back to today.
Right. So it captures both the service the employee has already provided and the service they are expected to provide in the future.
But the accounting boards, they don't actually let companies put the PVFB on the balance sheet, do they?
No, they don't. Because recognizing a liability for work an employee hasn't even done yet, well, that violates the matching principle we just talked about.
I mean, it makes sense. It would be like recording a liability today for a salary you expect to pay a worker 10 years from now.
Exactly. You wouldn't do that for wages, so you can't do it for pensions. Which brings us to the metric that actually drives the financial statements.
The projected benefit obligation, the PBO.
Right, the PBO. So the actuaries take that massive PVFB and they carve out only the portion attributed to past service, the work the employee has already completed.
Okay, so just the work done up to today.
Right. But crucially, and this is a big catch, the PBO still includes the expected future pay increases.
Wait, hold on. If the PBO is strictly for past service, why does it include future salary growth?
It seems counterintuitive, right?
Yeah, I mean, if an employee quits today, they don't get the benefit of salaries they haven't even earned yet.
True. But you have to remember that most traditional defined benefit plans are final pay plans.
Meaning the payout is based on their salary right before they retire.
Exactly. The retirement annuity is calculated using an average of, say, the last 3 to 5 years of a worker's salary. So the accounting philosophy argues that the service provided in year one is an integral stepping stone to that final higher paid retirement benefit.
Oh, I see.
Yeah. If you didn't include projected salary growth, the pension expense would be tiny in the early years, and then it would just explode exponentially in the final years before retirement.
So including future salaries in the PBO smooths that economic cost over the entire working life.
Precisely. It keeps the expense relatively level as a percentage of pay.
You know, it's kind of like hosting an open bar retirement party 30 years from now.
Okay, I like where this is going.
So the PVFB is the total estimated bar tab for the entire night.
Right.
The PBO is the tab for the drinks they've already earned working up to today. But assuming top shelf liquor, because we project they'll get promoted to the executive suite by the time the party actually happens.
That is a brilliant analogy.
Yes.
You are booking the liability for the top shelf liquor today, even though they are currently drinking well liquor.
Exactly. And that brings us to the final metric, which is the accumulated benefit obligation, or ABO.
Right. The ABO represents the strictest, most conservative view. It measures the past service, but it assumes the employee's current salary is their final salary.
So no top shelf liquor.
Exactly. It's the tab for the drinks earned to date, assuming they only get well liquor based on their current title.
So if the company froze the pension plan today, meaning no more benefits earned, no more salary increases recognized in the formula, the ABO is roughly the economic settlement value.
Yeah, that's essentially it. It's the walkaway number.
But for a going concern, a company that's continuing normal operations, JAP anchors the balance sheet to the PBO. That is the liability they have to report.
Correct. The PBO is the anchor.
But the liability is just a snapshot on the balance sheet. For you listening, if you're analyzing a stock, you know that investors spend most of their time looking at the income statement.
Oh, 100%. The P&L is where the action is.
So how does that massive PBO translate into an annual expense?
Well, it flows through a notoriously complex line item called net periodic pension cost, or NPPC.
Net periodic pension cost.
Yeah, and it is not a single economic event. It is an amalgamation of several distinct components all netted together.
Which are?
You've got service cost, interest cost, the expected return on plan assets, and amortizations.
Okay, let's break those down. Let's isolate service cost first. I know actuaries sometimes call this normal cost.
Right. So service cost is the present value of the new pension benefits earned by employees working during the current year.
So it's the cost of the labor right now.
Exactly. It is the pure operating cost of the labor. If, say, a 50-year-old manager earns an additional $1,000 a year in future retirement income just for working in 2026, the actuary calculates the lump sum required today to fund that specific $1,000 annuity starting at age 65.
And then they discount that lump sum back to today.
Right. That discounted lump sum is the service cost, and it adds directly to the NPPC expense.
Okay, so that functions exactly like a wage expense. It makes total sense.
It does. But the second component, interest cost, that has absolutely nothing to do with people working.
Right. Interest cost is purely the time value of money, isn't it?
Exactly, because the PBO is a discounted present value. As a year passes, you are 1 year closer to the actual payout date.
So the discount period shrinks.
Right. And because the discount period shrinks, the liability mechanically grows. You just take the discount rate and multiply by the beginning of your PBO.
So if your liability is $20 billion and the discount rate is 5%, your interest cost is $1 billion.
Exactly. And that $1 billion gets added to the NPPC expense.
Even if not a single employee clocked in for work that year. Even if the factory was completely shut down.
Even if the company had zero revenues, the interest cost still ticks up.
Wow. Okay, so that's the expense side. But this brings us to the most controversial component of the formula.
Oh, yeah. This is where it gets crazy.
The mechanism that offsets those expenses. The expected return on plan assets.
Right. Because these plans are funded with a massive pool of assets held in trust, those assets naturally generate returns. And the accounting rules actually allow companies to subtract those returns from the NPPC.
Effectively lowering their reported pension expense.
Exactly. It's an expense reduction.
But wait, the key word there is expected return. They subtract an assumed long-term rate of return, not the actual real-world returns the trust generated that year.
That is the magic trick of pension accounting. Yes.
But why? Why are accounting rules allowing an imaginary number to offset real operating expenses like service cost?
Well, you have to look at the philosophical debate within the FASB back when these standards were first drafted.
Okay, what was their argument?
So pension trusts are heavily allocated to equities, stocks, right? And equities are naturally volatile.
Yeah.
If a company was forced to run the actual quarterly return of its pension trust through its income statement, the resulting NPPC would violently swing from quarter to quarter.
Right, you'd have a massive expense in a bear market and then suddenly a massive profit in a bull market.
Exactly, and the core operating performance of the business would be completely obscured.
I see. So if you're trying to analyze if a company is getting better at, say, manufacturing jet engines, their operating income would instead be dictated by whether the S&P 500 went up or down 15% that quarter.
Right. You wouldn't be able to tell if they were a good manufacturer or just lucky with the stock market. So the FASB argued that pension plans are ultra-long-term, multi-decade obligations.
So they should use long-term averages.
Exactly. Therefore, the accounting should reflect long-term expected averages, not short-term market noise. So management selects a long-term expected rate of return. Historically, this was around 7% or 8%, and they multiply it by the asset base.
And they use that steady, smoothed number to reduce their expense year after year after year.
Exactly. It creates a very predictable P&L impact.
Look, I mean, that smoothing justification makes logical sense in a stable theoretical model.
Sure, in a vacuum.
But it creates a massive vulnerability for investors when that theory collides with a sustained market shock.
Oh, absolutely. It falls apart completely under stress.
Let's look at the historical data on this, specifically the bursting of the dot-com bubble from 1999 to 2002.
It is honestly the perfect case study of how smoothing mechanisms can just detach financial statements from economic reality.
So what happened?
Well, during that period, the stock market plummeted. Pension trusts, which were heavily exposed to equities, were losing billions in actual economic value.
The actual cash in the trust was vanishing.
Right. The foundations of these plans were literally crumbling. But if you looked at the aggregate net periodic pension cost reported on the income statements of S&P 500 companies during that exact same period.
A bizarre illusion occurred.
Bizarre is the right word. In 1999, the aggregate NPPC actually turned negative.
Negative, meaning the plans were generating phantom accounting income.
Yes, they were acting as profit centers, artificially boosting the corporate bottom line. And incredibly, they stayed negative through 2000 and 2001.
Right in the teeth of the crash.
Exactly. While the market was bleeding out, companies were reporting pension profits.
But wait, how does the math even allow a company to report income while losing billions in real assets.
It was two mechanisms working in tandem. First, corporate treasurers simply refused to lower their expected rate of return assumptions.
Of course they did.
Yeah. Even as the market cratered, companies kept their assumptions pinned high, between 8% and 10%. So mathematically, they were projecting massive gains and subtracting those imaginary gains from their expense.
They just leaned on the 50-year historical average of the market and completely ignored the immediate reality of the crash.
Exactly. But the second mechanism is what truly distorted the picture. It's called the market-related value of assets, or MRVA.
MRVA. Okay, how does that work?
When computing the expected dollar return, companies don't actually have to multiply their 9% assumption by the actual mark-to-market value of the trust on January 1st.
Wait, really? What do they multiply it by?
They are allowed to use a smoothed asset value. The MRVA amortizes past market gains and losses over a period of up to 5 years.
Oh, wow. So in 2001, they weren't just using an optimistic 9% rate.
Yep.
They were multiplying that 9% against an asset base that was artificially inflated. They were still slowly recognizing the unprecedented bull market gains of 1997, 1998, and 1999.
You nailed it. The delay in recognition allowed the bubbly gains of the late 90s to continue suppressing pension costs and propping up reported earnings all the way into 2002.
It essentially hid the true economic damage from investors who were only looking at bottom line earnings per share.
Exactly. If you weren't reading the footnotes, you had no idea the pension was dying.
You know, it's like driving a car with a blacked out windshield and you're steering entirely by a 5-year moving average projected on the dashboard.
Yes.
You think you're cruising on a straight highway because the average looks so smooth, completely unaware that you're actually driving off a cliff.
That is exactly what happened. And the critical takeaway for an analyst here is that smoothing mechanisms delay reality. They do not erase it.
Because eventually the 5-year moving average catches up to the cliff.
Exactly. The actual losses have to be recognized at some point. The math demands it.
Which brings us to the containment mechanism. Because, how do the accounting rules prevent that moving average from permanently detaching from the actual bank account? The expected assets can't be listed at $10 billion if the trust only holds $50.
Right. The FASB isn't totally blind. They reconcile it through something called actuarial gains and losses. And these accumulate in a holding pen on the balance sheet called Other Comprehensive Income, or OCI.
Okay, let's break down what actually triggers these gains and losses, because the entire pension math is built on long-term assumptions, right?
Lots of them.
You've got the expected return on assets, the discount rate, employee turnover, salary growth, and mortality rates.
And as we all know, reality rarely matches the assumptions perfectly.
Almost never.
So if the trust returns 2% when you expected 8%, that difference is an actuarial loss.
Right.
Or if life expectancies jump and actuaries had to update the mortality tables, meaning they project payouts will last longer, the PBO rises. That increase is also an actuarial loss.
And over time, these variances just pile up in OCI.
Exactly. They are kept safely away from the income statement to preserve that smooth NBPC we talked about.
But they can't stay in OCI forever, right? If the holding pen gets too full, it has to spill over into the income statement eventually.
Yes, and it does that through something called the 10% corridor rule.
The 10% corridor rule. Explain that.
Okay, picture a physical hallway.
Okay.
The width of this hallway is calculated as 10% of the greater of two numbers, your PBO or the fair value of your plan assets.
Let's use some numbers. Say your PBO is $10 billion and your assets are $8 billion.
Right, so you take the greater number, which is the $10 billion PBO. 10% of $10 billion is $1 billion. So your hallway is $1 billion wide.
Okay, so as long as your accumulated unrecognized losses sitting in OCI stay under that $1 billion mark, you do nothing.
Exactly. You do absolutely nothing. The variance is just considered normal noise. The MPPC stays perfectly smooth.
But what if a market shock hits or interest rates suddenly plummet and your accumulative losses balloon to, say, $2.5 billion?
Then you have breached the corridor. You have $1.5 billion in excess losses sitting outside the hallway.
The holding pen has overflowed.
Right. But the accounting rules still won't let you recognize that entire $1.5 billion hit immediately on the P&L.
Because that would cause a massive, unpredictable EPS shock.
Exactly. It would terrify Wall Street. So instead, you amortize it. The rule dictates that the excess amount, the $1.5 billion, must be divided by the average remaining working life of the plan's active participants.
Wait, the average remaining working life?
Yes. So if the average worker in the plan is expected to stay with the company for another 15 years, you divide $1.5 billion by 15.
Which is $100 million.
Right. And you add that $100 million amortization penalty to your NPPC every single year for the next 15 years.
Wow. So it slowly bleeds the economic reality back into the earnings.
Slowly but surely.
But, and this is a huge but, there is a demographic time bomb hidden in this specific calculation, isn't there? The math breaks down based on how modern corporations actually manage their workforces today.
You are exactly right. It's a massive issue. Over the last 20 years, the major trend in corporate finance has been closing or freezing defined benefit plans.
Right, because companies realized the risk was just too high. So they shifted employees to defined contribution plans like 401k.
Exactly. Now, a closed plan allows current workers to keep earning benefits, but no new hires can join. A frozen plan means even current workers stop earning new defined benefits entirely.
So think about what that does to the amortization fraction we just talked about. If the plan is closed, no 25-year-old recruits are entering the pool to pull the average working life up.
Exactly.
The active workforce within the plan simply ages every single year.
Which means the denominator shrinks rapidly. That average remaining working life drops from 15 years to 8 years to maybe just 4 years.
Oh, wow. So let's rerun that math. If you have that same $1.5 billion loss outside the corridor, dividing it by 15 years was a manageable $100 million hit.
Right.
But dividing it by a shrinking remaining working life of just 3 years, that's a $500 million annual hit to the bottom line.
Yes. As the population ages, the amortization period compresses, and it violently accelerates the recognition of those losses.
So the exact mechanism that was designed to save companies from earnings volatility actually becomes an engine of extreme volatility.
It's an incredible irony, and it's exactly why corporate treasurers are now obsessed with pension risk transfer, or PRT.
PRT, right.
If the liability is generating too much interest cost and the amortizations are becoming too volatile to manage, the only permanent solution is to get the liability completely off the balance sheet.
They want to shrink the pie.
Exactly. One way they do this is by offering lump sum windows to former employees.
Trading a single cash payment today for a legal release of the lifetime annuity obligation.
Right. Take $100,000 now and we never owe you another dime. Or they execute an annuity buyout.
How does that work?
The corporation takes a massive chunk of the pension assets and simply transfers it to a life insurance company. The insurer assumes the legal obligation to issue the monthly checks to the retirees.
So the PBO shrinks, the asset base shrinks, and the volatility is permanently removed from the corporate financials.
Exactly. It's clean.
But risk transfers are expensive. Insurers charge a premium to take on that longevity and market risk.
Very expensive.
So there is a cheaper, entirely administrative way managers attempt to shrink their liabilities, isn't there? By playing with the math, specifically manipulating the discount rate.
Ah, yes. The discount rate. It is arguably the most powerful lever in pension accounting.
Because of its inverse relationship with the present value of the liability.
Exactly. If you increase the discount rate, meaning you assume the funds can earn a higher yield over time, you mathematically require fewer dollars today to fund the future promise.
So the PBO shrinks mechanically. You didn't actually do anything. You just changed a percentage and boom, billions of dollars of liability vanish.
Just like magic. And GAAP dictates that the discount rate should reflect the rate at which the pension benefits could be effectively settled.
Which practically means it's pegged to the yields of high-quality corporate bonds, typically those with an AA credit rating.
Right. But here's the problem. A corporate bonds is not a single, universally agreed-upon number you can just look up.
It's not just one yield.
No, it is a vast universe of bonds forming a complex yield curve. Actuaries have to match the duration of the expected pension payouts to specific points on that yield curve.
So there is inherent ambiguity in constructing that specific rate.
Massive ambiguity. And where there is mathematical ambiguity, there is room for managerial discretion.
Or manipulation.
Well, yes. And we can see this play out vividly by looking at the behavioral data surrounding a major regulatory shift a while back.
You're talking about the 2006 rule change.
Exactly. Prior to 2006, the actual funded status of a pension plan, the total PBO minus the total assets, was mostly relegated to the footnotes of the financial statements.
It wasn't actually recognized as a primary liability on the balance sheet itself.
Right. For many investors and for debt covenant calculations, it was basically out of sight, out of mind.
But then the FASB issued Statement of Financial Accounting Standards number 158, coupled with the Pension Protection Act of 2006.
Right, SFAS 158. And this rule forced companies to drag the funded status out of the footnotes and recognize it directly on the balance sheet.
So overnight, companies that appeared completely financially healthy were suddenly forced to report billions in new liabilities.
It was chaos. It crushed their debt-to-equity ratios and potentially triggered technical defaults on their debt covenants.
So how did management react to being forced into the sunlight?
Well, researchers analyzing corporate behavior around this rule change found a profound agency problem. Following the mandate for balance sheet recognition, firms, particularly highly leveraged or financially distressed firms, began systematically selecting higher discount rates than their healthier peers.
They crept higher up the yield curve, or they instructed their actuaries to construct custom bond portfolios utilizing slightly higher yielding, perhaps borderline AA bonds.
Yes, all to artificially suppress the PVO. The sunlight of transparency literally forced them to find shadows in the mathematical assumptions.
Because external auditors rely so heavily on the complex modeling done by the company's hired actuaries, as long as the selected rate was technically defensible within the broad universe of high-quality bonds, it passed audit.
Exactly. It completely proves that pension accounting is not merely a hard science. It is a behavioral science deeply influenced by managerial incentives and the pressure to maintain perceived financial stability.
So transparency actually encouraged manipulation in a way. It's like telling someone they have to weigh themselves in public, so they suddenly decide to calibrate the scale on the moon where gravity is weaker.
That is exactly what they did. We'll weigh ourselves, sure, but we're going to use moon gravity.
Okay, so we have clearly established that traditional defined benefit plans are complex enough to manipulate.
Without a doubt.
But the landscape has evolved. To mitigate these massive risks, companies have spent the last 2 decades designing even more complex structures.
They really have.
So we need to venture into the advanced edge cases, specifically the rise of hybrid plans.
Hybrid plans introduce a staggering level of accounting friction. Just staggering.
Let's define the baseline first. In a traditional plan, the company promises a fixed dollar amount, say $1,500 a month, and bears 100% of the investment risk.
Right. If the trust assets underperform, the company must fund the shortfall out of pocket.
But to share that risk, companies developed cash balance or hybrid plans featuring an asset return promise.
Exactly. So in these plans, the employer guarantees a minimum floor, say, an annual return of 3% on the notional account balance.
Okay.
But if the actual pension trust assets generate an 8% return, the employee receives the full 8%.
So it is essentially a defined benefit plan with an embedded options contract.
Yes. The employee participates in the upside of the market, but holds a put option written by the employer that protects them against the downside.
I mean, that sounds like an elegant design for both the employee and the employer, right?
It is elegant in reality. But under current international accounting standards, specifically IAS 19, valuing an obligation where the final payout depends on the future performance of a volatile asset pool. Well, it creates a mathematical absurdity.
The accounting mismatch.
Yes, the accounting mismatch. Let's walk through the mechanics of this because it's wild. Under IAS 19, the actuary must first project the final benefit out to the retirement date.
Right.
Because the employee is entitled to the actual asset returns if they exceed the floor, the standard requires the benefit to be projected forward using the expected rate of return on the assets.
Let's assume that expected return is 7%.
Okay, so you compound the account balance at 7% annually for the next 20 years.
That becomes a massive number.
Huge. But then, to calculate the present value of that massive future number, IAS 19 forces you to discount it back to today using the standard corporate bond rate.
Wait. Let's say the 8A corporate bond rate is 4%. You are projecting the liability growing at 7%, but discounting it back at only 4%. If your growth rate is substantially higher than your discount rate, the resulting present value will be vastly larger than the current amount of money actually sitting in the account.
Exactly. Even if the company contributes $50,000 into the plan today, and it is 100% fully funded in economic reality, projecting at 7% and discounting at 4% might force the company to record a liability of $80,000 today.
So the standard forces the recognition of a massive phantom upfront liability.
Yes. The measurement of the obligation and the measurement of the assets are entirely disconnected. They do not capture the economic covariance between the two.
And IAS 19 compounds this distortion with a rule called the backload correction, doesn't it?
Oh, the backload correction makes it even worse.
Yeah.
If an employee's service in later years leads to a materially higher benefit than in earlier years, the benefits must be attributed on a straight line basis over their entire career. Because compounding a 7% return over decades makes the final years look exponentially larger in nominal terms, the backload correction forces the company to front-load even more of that phantom expense into the earliest years of employment.
It severely penalizes companies for expecting their assets to perform well.
It's totally backwards.
So if IAS 19 is fundamentally broken for hybrid plans, how is the industry trying to fix it? Because I know they are.
They are. The European Financial Reporting Advisory Group, or EFRAG, has spent years modeling alternative accounting solutions to resolve this mismatch. They have debated 3 primary theoretical approaches.
Okay, what's the first one?
The first is the capped asset return approach.
Let me guess. You simply cap the projected expected return at whatever the discount rate is.
You got it.
So if the discount rate is 4%, you project the benefit forward at 4% and you discount it back at 4%.
Exactly. It instantly solves the mathematical mismatch. The present value equals the current account balance.
But it completely ignores economic reality. It pretends the upside potential, the exact feature the company actually promised the employee, doesn't exist.
Right. It fails the test of faithful representation.
So what is the second approach?
The fair value-based approach. This method abandons the traditional projection and discounting model entirely.
Oh, completely.
Yeah. Instead, it measures the obligation simply as the current fair value of the plan assets plus the fair value of the minimum return guarantee.
But wait, the minimum guarantee is an embedded derivative. It is a put option protecting the employee's floor. So how do you find the fair value of a decades-long put option on a bespoke pool of pension assets?
You have to apply quantitative finance models, like the Black-Scholes options pricing model or complex Monte Carlo simulations.
Wow.
The actuary has to input the underlying asset value, the strike price, which is the minimum guarantee, the time to retirement, the risk-free rate, and crucially, the implied volatility of the pension trust's specific asset allocation.
So if the pension trust is heavily weighted toward high beta equities or alternative investments, the implied volatility input spikes, which makes the put option massively expensive to value today.
Precisely. It is mathematically elegant, and it captures the true cost of the guarantee. But it faces fierce resistance.
Why?
Because it violates the foundational premise of pension accounting, the equitable allocation of cost over a working life. Valuing the pension strictly as a tradable financial derivative introduces extreme quarter-to-quarter volatility. It treats a long-term employed contract like a speculative trading desk position.
Which brings us to the third option, the attempt to somehow balance economic reality with the matching principle.
Right, the fulfillment value approach.
How does that one work?
The fulfillment value approach is incredibly robust, but highly complex. It starts by estimating all total expected future cash outflows, modeling out the various probability-weighted scenarios of the final payouts based on both the asset returns and the guarantee. Then, it subtracts the expected future inflows, such as future employer contributions and the projected value of the employee's future service.
So it projects the net cash flow of the entire arrangement.
Yes. And here is the critical pivot. It discounts that net cash flow back to today using a rate that reflects the actual expected return on the plan assets, entirely discarding the disconnected corporate bond rate.
Oh, wow.
Finally, it applies a specific separate risk adjustment to account for non-financial uncertainties, like longevity risk or shifts in employee demographics.
I mean, that requires projecting stochastic cash flows, pricing options, forecasting service value, and building custom risk premiums. It's intense.
Very intense.
But if you are an analyst trying to accurately value the equity of a company offering these hybrid plans, I have to push you on this. Which of these models provides the truest signal?
I really believe it's the fulfillment value approach. Despite its immense complexity, it provides the highest fidelity signal for an investor.
Why is that?
Because by discounting the obligation at the asset return rate, it perfectly captures the economic covariance. If the assets surge in value, the liability surges in tandem, because the upside belongs to the employee. The mismatch is eliminated. Right. The only net liability that emerges from the math is the true economic burden of the floor, the guarantee adjusted for real-world demographic risk. It tells the investor exactly what the ultimate settlement cost to the entity is likely to be.
That makes total sense. Well, this has been a massive journey through one of the most opaque areas of corporate finance, Let's just summarize the landscape we've covered for everyone listening.
It's a lot to digest, for sure. We established the hard divide between the cash-based, highly regulated funding rules designed for benefit security and the accrual-based accounting rules designed to allocate cost over a working life.
Right, and we mapped the anatomy of the liability from the theoretical maximum PVFB down to the PBO, which anchors the balance sheet by valuing past service with projected future salaries.
We decoded the net periodic pension cost, exploring how service cost and interest cost are offset by the expected return on assets.
And we saw how the combination of expected returns and the 5-year market-related value of assets created that smoothing illusion, famously allowing S&P 500 companies to report phantom pension profits right through the devastation of the dot-com crash.
Right. We also detailed the mechanics of other comprehensive income and the 10% corridor rule, highlighting how the demographic shift toward frozen plans has compressed average working lives, turning the amortization of deferred losses into a trigger for extreme earnings volatility.
We analyzed the behavioral finance data surrounding SFAS 158, revealing how transparency mandates incentivize distressed firms to manipulate discount rates. They exploited the ambiguity of the yield curve to artificially shrink their reported obligations.
And finally, we explored the frontier of hybrid plans, the IAS 19 accounting mismatch, and the complex options pricing math required by the fulfillment value approach to capture the true economic covariance of an asset return promise.
The ultimate takeaway for you, the analyst, is that you can never take the bottom line earnings of a company with a massive legacy pension at face value.
Never. A smoothed EPS number is not economic reality. You must become a forensic reader of the footnotes. You have to track the year-over-year changes in the discount rate and the expected return assumptions.
You must compare the actual cash contributions flowing into the trust on the cash flow statement against the smoothed NPPC expense hitting the income statement. If the cash outflows consistently dwarf the accounting expense, the company is bleeding.
Exactly. Look at the cash.
And as we close, I want to leave you with a final thought to mull over. We have spent an hour dissecting models built entirely on the premise of long-term predictability and historical averaging.
Right.
But we are operating in a macroeconomic environment where long-term trend lines are breaking. We are seeing unprecedented volatility in global interest rates, shifting inflation regimes, and medical breakthroughs in longevity that could render traditional mortality tables obsolete.
It's a completely new paradigm.
Right. So if a multi-billion-dollar legacy obligation is allowed to hide its true economic volatility behind 5-year moving averages, corridor rules, and decades-old expected return assumptions, are the equity valuations of these legacy corporations simply pricing in a mathematically smooth, fictional version of reality?
That is the question.
And if the underlying assumptions regarding asset returns and life expectancy fundamentally crack, what happens to the broader market when the 5-year moving average finally catches up to the cliff?
It is the systemic question lurking in the footnotes. The accounting rules are designed to prevent short-term panic, but in doing so, they may simply be delaying a much larger structural reckoning.
The pension ledger will never be perfectly clear, but hopefully you are now equipped to read the shadows it casts. Thank you for joining us on Talk Tickers. Keep digging, keep questioning, and we'll see you on the next deep dive.